Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's Thursday, the 14th of September, Bull versus Bear webinar. Steve Marley on the call here for Trade Day. Welcome, everyone. Welcome. So, CPI in the rear view mirror now, and all focus now shifting onto other events. We're going to talk about those today as we run through our usual run through in here. Our look at the calendar, the macroeconomic, the data, the fundamental, the central bank events, the geopolitical aspects that are impacting financial markets right here, right now. We'll take a look at all of those, looking at that calendar, looking at the different articles from the major news wires. We'll take a look at the charts as well to see where the trigger points potentially are going into today's activity. So first of all, first thing to say, just a bit of a plug here. I was on Schwab Networking here, Charles Schwab. The broker, I was on their Schwab network yesterday, post CPI, about 50 minutes after CPI, and just discussing CPI ahead of the US equity market open yesterday. So take a look at that. There's a brief part of the interview here on their Twitter feed. I've sent that into the chat, so you can see it in the chat. We'll also, I think we'll post it on social media. We'll also get it up in the forums, in the Discord group as well. We'll get it on the site as well, so in the members area, but it's on our social media already. If you haven't seen it, take a look. There's only a snippet of it there, but basically my view was, the market had actually reacted fairly positively to what was actually negative data. The close wasn't as firm as the initial move. So initially we got the knee-jerk down on the headline data, which was obviously negative. The algos, boom, seeing the numbers and sold it. It was very, very briefly sold off, and then it rebounded very quickly, and the market then rallied pre the US Open, and then we had like a more of a negative impact after that. So, but overall, the market, S&P was effectively flat. I think the Nasdaq was slightly up, the Dow was slightly down. Markets basically finished unchanged, but we had that spike down and then rebound, and that's kind of a decent rejection of the downside, particularly given, as I said on the interview, the data was warm. It's all about the market reaction to the data. The expectation for the data, then the market was hotter or warmer then. It wasn't particularly hot data. We'll take a look at the data in a sec. But the data was warmer than expected. The market could have easily sold off. If the bears wanted to, on that data, the bears, if they had control, they would have pushed the market down and through support levels. It spiked lower and then rebounded. And we got the opposite happened on bonds or on bond yields. The same happened on bond prices. Bond prices went down to lower prices, therefore higher yields, and then they reverse back up to higher prices, lower yields. And we'll be taking a look at that. I think that's really important. The other thing I mentioned in the interview was the concern about oil, and we looked at oil and gold charts as well. The charts that I share with you, they're exactly the same charts that I shared on Schwab yesterday, the charts you get access to every day in the trading room, the S&P, the Nasdaq, the gold, and the oil chart. So we discussed all of those, and my concern for the equity markets, the concern came from the oil chart. And if you look at the actual bond chart, which we'll look at shortly, the bond chart's actually sending a positive signal, I think, for stocks, but the oil is still a worry. Oil up higher again in here today. So take a look. It's only a brief snippet of the interview. I think they've got 4 minutes on here. I think the interview is about 10 minutes long, but take a look at that if you get a chance. So let's take a look back before we take a look forward. So yesterday, let's take a look at that CPI data. So a lot of it was, parts of it in line. So the year on year on the core number was in line. The core month on month was slightly hotter at 0.3, up 0.3 rather than up 0.2. And then on the headline data, the month on month was bang in line at 0.6, and the year on year headline data was at 3.7 versus 3.6 expected. So it's only it's not hotter than expected inflation. It's slightly warm, you would say, in there. So not particularly aggressive, but nevertheless enough to potentially sink stock indices. Obviously higher inflation means potentially a more hawkish Fed. A more hawkish Fed then equals a potentially negative for stocks. Okay, but we didn't see that. We saw stocks spike lower and then rebound, or the stock indices anyway. So I think there was a positive reaction to negative data in here. Nothing really else of note in here on the overnights in here. We did get the Australian employment report, slightly better. You can see in green in here, slightly better than expected, but nothing that's going to really massively impact us. If we go into today, now we have two significant events. Really, the non-US one is probably more significant. We have the ECB. I've got a few articles on that. The ECB very much poised, the market very, very unsure. I mean, in here here it says rates staying unchanged. They might hike rates, okay? They may well hike rates. So watching out for that going into the day. It's kind of 50, almost 50-50. It's going to go down to the wire whether they hike rates or not today. Okay, so it's going to be interesting to see that. Obviously, if they do increase interest rates, that would be potentially a negative for European stocks and could tug US stocks down lower. That comes out in just under 1 hour's time in here. Actually, 40 minutes time in here. So about 40 minutes time in here. We get 39 minutes time, actually. So that's quarter past the hour, I believe. Yeah, that's quarter past the hour. We get the decision from the ECB. I think that's right. Yeah, 39 and 36. That's right. 36. Yeah. A quarter past the hour. We get the ECB. Yeah, the ECB decision. Okay, that's the decision. Then we get the press conference. That comes at 8:45 Eastern. Okay, so we're watching out for that as well. After that, in between those two events in here, we get the US data in here. So we get PPI. The PPI rarely moves markets. What's probably more important is the retail sales data. Expected in here on the month-on-month data to come in at 0.4. We do get the PPI as well. The month-on-month data expected at 0.4 also, coincidentally. 0.4 in the core retail sales month-on-month. PPI expected month-on-month to come in at 0.4 as well. The PPI probably less important unless it's significantly out of line in here. And that's core retail sales at 0.4. The headline number is expected to come in at 0.2 on the month-on-month. So those are the numbers you're watching out for coming up in here. I think in here, it really is the ECB is probably more important. It could have a bigger impact. PPI, as I say, not usually a big mover of markets. The ECB potentially, if they do hike rates, if they show any kind of hawkish tone, is very likely to be negative for European stock indices and could tug US equity indices down. Remember, we are in a global world. Okay, so yeah, that's all we got coming up in here today. A little later on, actually, we do get some small data as well from the US business inventories at 10 o'clock Eastern. Maybe watching out for that as well. Remember, no Fed speakers at the moment. We are on the Fed blackout period as we run into the Fed meeting now coming up next week. Next Wednesday, we get that decision. Let's run through some of the major articles. 5 things to start your time. So the ARM IPO. This is the IPO of ARM, chip maker in here, chip designer. Okay, has gone very, very well in here as expected. Trading starting today in here, so it's going to be interesting to see how that pans out through the day. But generally speaking, a very positive IPO from ARM in here. Goldman firings, not really worried about that. Dalio warning, doesn't want to own bonds and prefers cash, not too worried about that. Futures are positive in here. European, Asian futures all positive, building on the rebound that we saw, kind of the sell-off and rebound that we saw through the actual data coming out yesterday. But the euro is a little bit wobbly and markets a little bit tentative in here going into, so as I say, in here about 40 minutes time there. We have the 8:15 Eastern, we get the ECB rate decision, and then 8:30 Eastern, we get the retail sales and PPI data plus jobless claims, and then 8:45 we get the actual the decision in here from the press conference from the ECB. Okay, so 8:15, 8:30, and 8:45 Eastern time coming up. So all kicking off in about now, 35 minutes time in here with the ECB rate decision. And so futures climb on Fed pulls hopes. Okay, so I think the important thing in here was how the Fed tool. We'll come to the Fed tool. How the Fed, the short end interest rate market moved, and how the and then obviously we've got ARM coming up, the ARM debut. But how the market, the short end interest rate market, so that's shown in the Fed tool, and also the bond market reacted. And I think that positive reaction shows that the market is now really expecting the Fed to probably stay on pause, stay on hold, and if that is the case in here, markets are taking that, equity markets are taking that as a positive in here. A couple of articles on the ECB's razor edge decision rests on price action. In Bloomberg, almost evenly split on the outcome. Okay, so whether they stay on pause or whether they deliver a 10th straight interest rate increase. Okay, whether they're going to go on pause or 10th interest rate increase, not stay on pause. Sorry, move to a pause. ECB ways lifting rates to record high even as economy slows. So we've been looking at that negative growth data, the negative expectations for the Eurozone as a whole and for Germany. Retail sales and a call to ARM. So again in here, focusing on the data we have coming up from the US retail sales and also that IPO and how that's going to go going into today. Euro wobbles before ECP. Oil, and this is the other thing I've been talking about. I mentioned it on the interview yesterday on Schwab Network. In here was the oil. The continued strength in oil. Why is it a negative for stocks? It's a negative on two fronts in here. One, higher oil prices feed into inflationary pressures. Remember that CPI data we had, has not really picked up on the fact that oil has been notably higher in here over the past. If we go and jump to the oil chart, over the past, that's not the oil chart. Let me go to the oil chart. Look what oil has done in here over the past month. Okay, it's up from like $77 to 89, approaching $90 in here, right? So what's that? 77 up to 90 is up $13, right? $13 on 77 is the best part of what? 20%. Best part of 15 to 20% up. Okay, the oil price that can potentially significantly feed into inflation. Okay, not only in the US, globally. Okay, so one, global inflationary pressures potentially coming from oil. Two, those higher oil prices are kind of like, just think of it like, it's like a tax almost, right? You kind of have to still pay it, right? People don't stop driving, factories don't close down, I don't know, haulage companies don't stop hauling, right? They have to keep paying for petroleum. Oil has to keep, it still keeps pumping, and it keeps getting purchased just at a higher price. So it's kind of, think of it like a tax. So, and basically we'll just slow down the economy, not only the US economy, the global economy. Okay, so this oil price hike in here is a real concern for growth, and it's a real concern for inflationary pressures as well. So that is a bit of a worry, given that we had this little bit of a pause in here. We had previously had a pause here and broke out. I spoke about it yesterday. We had this breakout. We're kind of hitting the target on this breakout, but then we've had this other pause in here over the last week or so, and we're breaking out from that. So oil could easily move up to mid-90s over the next couple of weeks in here, maybe even towards 100. And if it gets up towards there, that's going to be really cause some issues for, I think, stock markets in here if we continue to go higher with oil into the mid-90s and above. So watching out for that as we go forward. What else do I have for you? ECB retail sales, oil, we're talking about. Okay, US house prices in here showing this slowdown in Europe, showing the slowdown in the UK. House price gauge, the UK house market in here, housing market is a very important component, as it is in a lot of economies, but particularly big in the UK, okay, for the health of the economy. And the house price gauge hits a 14-year low as the higher interest rates that we've had, the continued higher interest, we've had the expectation of maybe even higher interest rates in the UK in here continue to weigh not only on the housing market, but also starting to weigh more on the economy. We've got these around the wrong way a little bit, but oil trading higher, and that's a bit of a concern. This is a positive though. Now here's the yield chart. Remember, we look at this, the US 10-year yield chart, and we'll come to the short end at the moment with the Fed tool and the CME Fed tool. But look, we spiked up very close to this peak that we put back in here at the latter part of August, the 22nd of August. We spiked. So basically the market went boom, boom, up and down, up in higher in yield, which is lower in price. And if we flip to the bond chart in here, here's the 10-year. So you can see we spiked down. If I go all the way into like maybe a 1-minute chart in here and then spike back to the, if I can get back to as far, I'm going to make it a 5-minute chart. Was it might not be able to get back to, there's the data, right? Here's the data, okay? So we had this big spike down on the data, right? And then it was very quickly back up, it was in a few minutes, okay? And then higher, and then went higher through the session. We have rolled back slightly lower to lower prices equals higher yields, okay? But this spike lower and then rebound. If I flick it back to the daily chart in here, that created this hammer type pattern, okay? And the hammer pattern, you can see we spiked below the low in price here from the 22nd of August. But if we go back to the yield chart in here, we didn't quite make it to the higher yield. So the high yield over here was 437 and 436.5 to 437. Yesterday we got up to 430, just above 435, and so we've kind of failed at this high yield. And you would argue as well, even on the price chart, the market rejected this low, rejected a break below this low, come back higher. So you get a hammer on the price chart, and then on the yield chart, whoops, wrong chart. On the yield chart, you get this kind of shooting star. It's like a shooting star, not a perfect shooting star, but it's like a shooting star. Shooting star usually at the top of a trend. So you got this mini uptrend in here. kind of did dip and rebound. So you got this shooting star. That's a bearish pattern in here. So in this case, pointing to lower yields, which equals higher prices. So in here, this hammer pattern in here pointing to higher prices. This is going to be the important peak up here. So in price terms on the US 10-year future on the December contract, up there at 110.10.5. Now I know a lot of you guys are not trading. I know you are not trading the bond markets. But as I've said before, this is the market. This is the dog that's wagging the tail. You should be watching these markets in here. And you can see it's been flirting with this 13 period EMA, flirting with it again. So we'll come back down lower side. If we can take out that peak there in price, that is at 110.10.5. If we can get back above 110.10.5 in here on the US 10-year future on the December contract, I think that opens up upside in here, and then we could see a better rally in the stock indices, particularly the NASDAQ. Remember, the NASDAQ is more sensitive to interest rates because it's got more growth stocks in it, and growth stocks are more significantly impacted by higher and lower interest rates. So higher prices on bonds equals lower long-term interest rates. It's all to do with the discounted cash flow on growth stocks. And because of that, then you would see potentially an outperformance by the NASDAQ. And that 110.10.5 levels I think is going to be important. If you are monitoring the yield chart, it needs to move all the way back down through that low yield there from the same day. That low yield point there is 421 on yield. So down through 421. Now, obviously, we're moving slightly in the opposite direction at the moment. But if we do get down through 421 and up on price and on yield and up above 110.10.5 on price on the 10-year future, that could be a signal for upside in stock indices. Okay, let's take a look at the Fed tool, the short end. So this has actually crept up after the data in here. If anything, you would expect this to have maybe gone the other way, that there's going to be more of a chance of an interest rate hike, but they haven't. This has crept higher to 97 now. And if we look now into the end of the year, okay, we've got now no chance of any kind of interest rate cuts before the end of the year. And we've still got a chance in here, but maybe slightly fading chance, in here, 45%, 44 to 45% chance of maybe a hike before the end of the year. This is for unchanged, okay? But still the betting on unchanged by year end. If we step out to March now, by March it's kind of really getting more to even Stevens, more likely to stay unchanged. The market is now pricing more of staying here and not moving from here. Look, 525 to 550 out to May now. Maybe a slightly better chance by May that we get an interest rate cut. By June, then we are looking for an interest rate cut. But now what we're looking for is rates to just maybe stay on hold where they are right the way through for maybe the next 5-6 months or longer out to May in here. So what's that? That's like eight to 9 months in here. That's what the market's pricing in. So the market's not really particularly aggressively pricing in any kind of rate cuts anymore, which we were looking for, because the market's almost just ticking along okay. The economy has slowed down, but it's not aggressively slowed down on the one front, and then inflation is not particularly coming down aggressively anymore, but it's equally probably not likely to go back up again. So the Fed more likely to stay where they are, and that's what the Fed tool is pricing in. Where are we on the overnights in here? Well, Asia did pretty well. Nikkei was up 1.4%. Hang Seng up a couple of tenths. Europe this morning in here is up 1% on the UK FTSE, 1.25%, on the UK FTSE, 0.25% on the German DAX, and nearly 0.4, just over 1/3% on the French CAC. And US futures in here this morning having kind of settled relatively unchanged. The Dow was slightly down. The Nasdaq, I think, slightly up. The S&P slightly down in here. And we're up, healthy this morning between 0.3 and 0.5%, 0.3 and 0.5% across the major indices. So we've looked at gold. We looked at oil. We looked at the bond chart in here now. I'm going to just jump across and take a look at the quick look on the equity indices. And I think the critical levels are here on the stock indices now. I'm going to look at them on the daily charts. These peaks in here from the last couple of days from early this week, Monday and Wednesday, they're going to be critical. Okay, so up on the top side in here for me, I'm coming into this bullish. You've got this kind of slightly bullish hammer candle there, slightly bullish hammer candle back in here from this low, and you can see what happens when we get these. We get the kind of here and we get it here, and then boom, the market moves away. You get it here and you get it here. Potentially, we've got a significant update coming today/tomorrow. Okay, so I'm looking for that peak there to be a really significant trigger for further upside. 45, 43.5, and ahead of there, you've got 45.39. Okay, so 39 and 43.5. Through there could easily open us to up to 45.70 today. Okay, and a quick dip into the shorter term chart in here. You've got this kind of. This looks to me like a bigger basing pattern has been forming in here. It's got slight higher highs. It's very, very erratic. And obviously through there reinforces that. And then if we look at on the bigger picture chart, it looks like a recovery. This still looks like the recovery as well in here, all the way up in here from the what's this, the latter part of August, right? Yeah, 20 whatever it is, 18th of August. Sorry, yeah. This whole recovery is very much intact. You put this kind of fairly shallow trend line on, but it works in here through here. We've kind of held there, right? And you've got a similar trend line with a similar slope coming across these two lows in here as well. Okay, so for me, that is the line in the sand going into today. I do think we can go and challenge these 39 and then what did I say, 43 and a half levels in here today, and up through there could easily open us up into here like 65, 70 kind of area top side. Similar story on the Nasdaq. Okay, we're seeing here again, look, hammer down. It was actually down here. We have hammer in here, and then it's sort of like hammer, pseudo hammers in here, and then similar down here, and then here, and then look, we took off in here. I think it's further to go for the Nasdaq. It's really up above these two peaks in here. Highs at 680 and 696 in here. We take those out, and it could be off to the races on the top side. Easily seeing maybe move to like 15,800. And here we go on the 30-minute chart. Again, this kind of base building been going on in here. One sec. So you've got like in here. I'll just actually do this as an array and extend it out. So you can see we've held that, and it's not a million miles away. If we go and then it's not really quite the same slope in here, but there you go. So we've defended that. Yeah, so really, I mean, up through here, but I mean, we've got, it's failed a couple of times in this area here around just kind of where we are now, back up above 15,635 and then 660 kind of area. I think we can take those out as quickly up to that recent high, just below 15,700, and then maybe as high as 15,800 today. So yeah, it's looking positive. It's a really positive setup in here today for me on the stock indices. But then you remember one thing, do watch those watch the bond market levels that we just went through and pointed out, and just keep an eye on oil as well, because if oil starts to ramp up, that's not good, I don't think. So just do keep an eye on oil. It's up at the highs in here. Obviously this is echoing the risk on theme, so in some ways it kind of correlated positively with stocks, but you don't want oil running away too high. If this starts to go too high, I think we'll get a focus onto this and stocks will come back lower. So it's already up a notable amount today. It's probably going to break I don't think we broke 90 yet, have we? No, where are we? High, yeah, 89.77. It'll probably break 90, maybe have a little rush above 90, but then you wouldn't want to see it much above 90 really. So just keep an eye on oil as well. Any questions? If not, I'll wrap us up. No questions? All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trade. Just a shout out, as we are running this Q&A on the Discord. It will stream as well. We're almost certainly going to stream it live into the. We'll get some notes up in the forums and elsewhere today. Might even and probably send an email out later today. But we're going to do this Q&A with James and I tomorrow. That is at. I'm going to have to do the maths very quickly. It's at 3 p.m. my time. So Eastern is -5. So what time's that? 10 Eastern. I think it's 10 Eastern. Yeah, 9. It's 9 Central, 10 Eastern. Yeah, 9 Central, 10 Eastern, and 3 o'clock UK, 4 o'clock if you're in Central European time. So that's the time. It will be streaming live in Discord. We'll also stream it live. Pretty sure we'll do it in this window here where you're watching this. It might be in a different window, but we'll give instructions on where it's going to stream, okay? And we'll let you guys know that beforehand. So watch out in the forums. There'll probably be an email sent as well. All right, guys, have a good one. Have a great one. Yeah, think of some questions. Ping some questions in through Discord. I know Sean's taking those questions, and we'll try and answer as much as we can. All right, guys, have a good one. Take care. Stay safe. Bye.